Are you an investor who's afraid of missing out on the market's biggest winners? Look no further because we have the perfect ETF for you. Today, we're going to be looking at the Vanguard US Momentum Factor ETF with the ticker symbol of the VFMO, which is the ideal choice for FOMO investors that don't want to miss out on those big gains. For a lot of individuals, it's absolutely dreadful if you miss out on a stock that skyrocketed like Nvidia over the past couple years, where we've seen 2, 3, 400% returns in some of the stocks within the market. Now, this is called the Momo cure for the FOMO. So again, we're going to be looking at the Vanguard US Momentum Factor ETF, which is the ticker symbol VFMO. Now, this one employs a very simple rule. It is quantitative modeled on the US stock system, and it invests in stocks that have strong momentum or strong movement. And the fund managers don't care if it's large cap, mid cap, small cap. It doesn't focus on any sector. It doesn't focus on any industry. It is literally only buying the best of the best stocks, which is kind of crazy. So you might expect with Vanguard and their ETFs, it has really taken off in the last 12 months, jumping over 30%. That is right, guys. We have seen over a 30% since this has actually inception. This was ETF that was started in 2018, and it has delivered an annualized return of 13.3%, which means that your money would double every 5.5 years. Now, we know the rule of 7, your money should double technically every 7 years, but if you can have an ETF that is going to allow you 5.5 years or 5.6 years to go ahead and double those funds, you are exponentially going to compile money much faster and your investment portfolio going up much faster. Now, of course, Vanguard is known for the low cost funds, which this is no exception to that. It has a 0.13, that is right, which is kind of crazy. ETF's dividend yield is a 0.46, so this is not one that you're looking to get dividends. However, big thing is the 0.46 dividend yield will cover that expense ratio that you have on an annual basis, which is kind of crazy. Now, another thing that I love about this funds is it is loaded with winners. Now, when you look at this, currently holds 574 stocks, which means the VUG, which holds just north of 200, the VOO, which holds just north of 500. This is holding 574 stocks with an average growth rate of 19.2%, which is kind of crazy. So looking at some of the holdings, and once we start breaking this down, I'm going to hop over to Vanguard's site so we can see a little bit more in depth what it is. Now, one thing that I love about this fund is it does not hold a bulk in technology. When you look at the VUG, I believe roughly 40% is held in just a few companies. Quick glance at the ETF top holdings, and the largest one is Meta Platforms, which makes up 1.64%. Where again, looking at Nvidia, looking at Apple, most of the other ETFs carry this 5, 10, 15, 12, 14%. A whole bunch out there carry it in a very different manner than this fund does. Shares of social media giant are up more than 130% in the last 12 months. Now, of course, number 2 comes in at Nvidia with 1.52, which again, they're not holding 8, 10, 12% of this fund. They are holding 1.52% because remember, this includes the large cap, the mid cap, and the small cap. The chip stock has vaulted more than 220% over the last 12 months, which is kind of crazy. They also hold Broadcom. They also hold Eli Lilly, a lot of the Vanguard holdings that are in different sectors. And again, this fund is actively managed. It is not a passive ETF, meaning that you put your money in, it's going to be invested in what it is. And then, of course, they're going to adjust this as some of these stocks go up and down. And as they come kind of here and there, if they're not poised for a lot of growth, actively managed, they're going to get rid of that. They're going to pick up another fund. And of course, the legitimate fear of the FOMO. This isn't really an issue when it comes to the momentum factor. You'll be virtually guaranteed to own any stock that is going to be the next big thing. But of course, the legitimate fear that we do have with this one is looking at the ability, or if stocks do kind of decrease or they do decline, if the market sees a decline. But overall, the big thing with this is if we start seeing it is designed, and this is the way that it works with the quantitative method, it will automatically replace underperforming stocks with others that have a strong momentum or perpetual cycle that we're going to see some growth. Turnover rate of the fund at the end of the year was 73%. That is right. So you won't be afraid to miss out on any of those big ETFs because you don't want to be scared or stuck into big losing stocks. This again is going to be crazy to see exactly how well this performs, which let's hop over and we'll go ahead and we'll take a look at it. So right here, the VFMO, I want to hop back to the top of this. I was kind of understanding it. This is a newer fund. Again, it was released in 2018, but this is one that I'm not really familiar with. Now, one thing to note with this is the risk scale. You can see risk reward scale. It is literally a 5 out of 5, meaning that there is a risk in this. The expense ratio is pretty low. But again, this is an actively managed fund, which I do like very much. Looking in here, of course, looking at the year-to-date returns, we're at 14.34%, which is awesome on the year-to-date returns. I believe the S&P 500 is around 8%. So you are seeing a very, very big chunk of this really being returned. So looking at the total returns, this is what I kind of wanted to break down. So since inception of 2018, we're running about 13.26%, which is kind of crazy. Now, one thing to remember with this one is the benchmark. So a majority of the ETF funds are benchmarked on the S&P 500. You know, it could be a couple ones. This one is actually benchmarked right down here on the Russell 3000 index. So it does have a little bit of a benchmark than what we see with the traditional ETFs from Vanguard that are usually, again, the S&P 500. But even when you look here, compared to that benchmark of the Russell 3000, in 1 year, they are up 35%, a little bit down on the 3-year. But again, the 5-year comes back at a 15% return, which is crazy. And of course, it hasn't been around for 10 years. But this, as an actively managed fund, is going to go ahead and swap out those stocks that are starting to decline or not seeing as much as the momentum or as the growth factor in there. And it is going to be poised and put into other ones in there, which again is really cool to see. Now, overall, the price, I like the market price of this, $150.01. Most of these Vanguard ETFs run $300, $400, $500, which means you're not buying as many shares because of the sheer cost of them, which means this could actually be looked at as a value based on how it is and how it is kind of built. Even looking at the historical prices, which again, it seems pretty well, but number of stocks, 574 stocks versus the benchmark. Now the Russell 3000 is of course 3,000 stocks. It is a pretty good benchmark. You can see we have almost $20 billion in here, but the earnings growth rate is 19.2%, which is kind of crazy to see. And then of course, this is what some people were kind of worried about was the price and earnings ratio, 21 times, where again, the benchmark of the Russell 3000 is at 24. And then of course, the return on equity, a little bit lower there. But overall, I want to see the funds. This is really the breakup or the breakdown of what I want to see. Now, again, looking at a majority of growth funds, you have a very, very big focus into technology, which again, we kind of see the same here, a big focus in technology. However, the actual holdings of this ETF are what I do like a lot. Because again, looking at a comparison of like the VUG, which is the Vanguard Growth Fund, they are very, very heavy into, you know, the Magnificent Seven overall, looking like a big chunk into Apple, into Meta, in a couple of these. Now, of course, looking at the percentage of the funds here and everything that they hold, the biggest fund, like we said, was the Meta platforms at 1.3%. But you have NVIDIA in there, you have Broadcom, you have Eli Lilly, you have Artisan Network, Netflix, Uber, General Electric. So these are focused on, again, the biggest and the most momentum factors that we have in the stock market as they see from this managed fund. So it is really interesting to see kind of how this is built. And again, when you talk about diversification, they're not focusing on any sector. They're not focusing on any industry. They are literally only focused on stocks that have a very, very high growth potential. And since 2018, so we're talking 6 years, they have done exceptionally well delivering on how much this has actually made within this stock itself. Now, of course, dividends, very small dividends. You can see the dividend actually decreased on March 26th. So, I mean, 15 cents a share, not really buying it for the dividend. We know there are some stocks out there. There are also some ETFs that will pay a lot more in the dividends itself, but this is definitely one to pick out. And I like how it is built. Now, what I'm thinking with this is possibly putting some in here and just letting it kind of sit and doing it long term. So this is not going to be something, again, that I'm going to consistently and consecutively be putting money into, but I can see setting up something like this for my kids. Again, when you think of the longevity of 10, 15, 20 years with an actively managed fund that is going to essentially FOMO into everything that you see. So the VFMO, definitely check it out. Let me know in the comments what you guys think of it. Very cool to see some of the Vanguard. And again, I'm not really particular to Vanguard, to Charles Schwab, to JP Morgan. whatever funds are out there, what is going to be the best funds. That is why I do a lot of the kind of comparison investing. What does it look like, from the VUG to a growth fund to another growth fund that is very similar? What are we seeing that they're holding? What is really the demand? What is the overlap of both of those? Because a lot of the funds do hold the exact same investment portfolio. Within those stocks, they do have kind of a build, little bit of a different ratio of what exactly they hold, but it does make a big difference. All right, guys, so that is going to do it for today's video. Let me know in the comments what you guys think, and I'll catch you in the next video.